Trading is simple if you know how to spot the right patterns. I was able to turn $100 into $350 in only 3 hours. How? Bullish chart patterns. And I'm going to break it down for you right now. My name is Mike, and I teach you how to trade right now. If you want to make money in the markets, stocks, currency pairs, and crypto, you've come to the right place. If you had to pick one, would it be a cat or a dog? Tortoise or the hare? A bear or a bull? If you're a trader like me, your obvious answer is a bull. Truth be told, we can make money in both market types, but psychologically, it makes more sense to buy when prices are going up, which is the basis of a bull market. Financial markets are categorized as either bull or bear. Today we're going to talk 5 bullish chart patterns in bullish markets. But first, there are 3 market characteristics you must know. The primary characteristic of a bull market is a sustained increase in the price of your preferred asset, be it a stock or a commodity, cryptocurrency or currency pair. The upward price movement is driven by strong demand from traders. In a bull market, traders are also optimistic about the future prospects of your investment. Corporate earnings, a key hire, or a new innovation. An unusually long winter that drives up the price of grain and other factors can contribute to a favorable outlook. Finally, bull markets are often associated with periods of economic expansion and growth. Positive economic data, such as low unemployment rates, rising GDP, and strong consumer spending can contribute to an overall bullish sentiment. These factors lead to a long-term optimism, which means we can buy now and sell later, with the expectation of making a profit as prices increase over time. Even more important than understanding the characteristics of a bull market is knowing how to identify a bull market. I find 3 ways to be easiest. First, we have a moving average, which is an automated calculation used to help traders forecast future prices. It plots and updates average asset prices, smoothing out random price fluctuations. The slope of key moving averages, such as the 50-day or 200-day, can signal a bull market. An upward slope suggests an overall positive trend. We can also use technical indicators like the Relative Strength Index, RSI, or Moving Average Convergence Divergence, MACD, to confirm bullish momentum. If you want to learn more about technical indicators, check the video link in the description below. I prefer to identify market conditions using market structure, which is a fancy way of mapping price movement. In a bull market, price consistently forms higher highs and higher lows. This establishes an uptrend. We believe that price will continue to increase over time. We track price increases using candlesticks. If your chart is set to the daily time frame, then each candlestick represents 1 day's worth of price data about your asset. You're given 4 pieces of information: the opening price, the closing price, the high price, and the low price. If you're interested in learning more about candlesticks, then check out the video link in the description below. For now, all you need to know are the basics. A green candlestick shows that an asset's price is moving up. We know this because the closing price is higher than the opening price. When you combine multiple candlesticks, they form a direction, confirming price is in an uptrend or a downtrend. You can add additional confluence or confirmation of trend direction by taking into account chart patterns. Chart patterns are simply recognizable shapes that predict price movement. I have 5 favorite bullish chart patterns: double bottom, triple bottom, ascending triangle, descending wedge, and the bullish flag. Let's break down each pattern one by one. The first pattern we're going to explore is the double bottom. The double bottom is a bullish reversal pattern that occurs after a downtrend and signals a potential trend reversal to the upside. This pattern is characterized by 2 distinct troughs or bottoms at approximately the same price level, separated by a peak in between, which creates a neckline. The double bottom typically forms after a prolonged downtrend. Traders are pessimistic, but the chart formation signals optimism. Speaking of which, let's head to the charts to see an example from Apple on the 15-minute frequency. The first step to identifying the double bottom is the formation of the first bottom, which occurs when price reaches a low point, forming the first trough. As price reverses, it looks like sellers are losing control. but not all together. The trend reversal peaks at the peak. After the first trough, buyers cause the price to rally until it reaches a peak. Following the peak, the price declines again, forming a second trough. The second bottom should be at approximately the same price level as the first bottom, creating a horizontal support level. Support is the price level where demand is greater than supply. There are more buyers than sellers, and because of this, price goes up. If you want to learn more about support and resistance levels, check out the video link in the description below. As price bounces off of the support level for the second time, the bullish reversal is confirmed when price breaks above the neckline formed between the two troughs. This breakout signals a shift in the market sentiment from bearish to bullish. We enter after the breakout, setting our stop loss outside both troughs. Our take profit point is the next key support and resistance zone, which is typically where the former downtrend began. As candles close, we find that the downtrend has in fact ended as we shift towards an uptrend. We're rewarded with a 1.5 to 1 risk-reward ratio, or we made $150 for every $100 we invested. The triple bottom chart pattern is a bullish reversal pattern that shares similarities with the double bottom pattern. However, instead of two troughs, the triple bottom consists of 3 distinct troughs, with each trough at approximately the same price level. Like the double bottom, the triple bottom signals a potential trend reversal from the downside to the upside. The triple bottom typically forms after a prolonged downtrend, signaling that sellers are in control. After the formation of 2 bottoms and 2 temporary rallies, it's not enough to confirm a full trend reversal. Buyers are not in control. Let's head to the charts to see another Apple example, this time on the 30-minute frequency. After a second rally, price declines once more, forming a third trough at or near the same support level as the previous 2 troughs. This establishes a triple bottom, indicating persistent support at that price level. When price bounces off the support level for the third time in rallies, it breaks through the neckline. The bullish reversal is confirmed after price breaks above the resistance level formed by the peaks between the troughs. This breakout signals a shift in market sentiment from bearish to bullish. Once again, we enter after the candles close above the neckline. This time, I set my stop loss halfway to the bottom, and my take profit target is the next key level of support and resistance. The candles close, and we achieve a slightly higher risk-reward ratio of 2 to 1, or we made $200 for every $100 we invested. Double and triple bottom patterns rely on similar shapes to signify sellers have lost control. The ascending triangle is another formation that reveals bulls are back in business. Let's dive deeper. Real quick, if you're enjoying this video, go ahead and like and subscribe below. With your support, I can continue to create free content just like this. It takes a second, and I so appreciate it. The ascending triangle is a bullish continuation pattern that is used by traders to identify periods of potential upward price movement. This pattern is formed during an uptrend and consists of 2 main components, a horizontal resistance line and an ascending trend line. An ascending triangle is formed when price creates a series of higher lows, indicating an upward trend. At the same time, there is a horizontal resistance level where price is struggling to break through. Remember, support is a price level where the market tends to reverse to the upside after a bearish move. Resistance, on the other hand, is a price level where the market tends to reverse down after a bullish move. The horizontal resistance level represents a price point where sellers have historically prevented buyers from pushing the price higher, but not for nothing. The ascending trend line represents higher lows and shows that buyers are willing to step in, slowly and methodically pushing price higher. As the price moves between ascending support and horizontal resistance, the range between the two narrows. The bullish breakout occurs when price successfully moves above the horizontal resistance level. We enter long after the breakout. Our stop loss is placed at or below resistance, turns support. Our take profit target is a key level of support and resistance. The candles close, and within 6 hours, we've achieved a 3 to 1 risk-reward ratio. We made $300 for every $100 we invested. If you remember, bull markets are marked by higher highs and higher lows. What's cool about the ascending triangle is you can watch the higher lows form one after the other. The trend line gradually ascends, forecasting the ascent in price. Descending patterns can actually forecast bullish sentiment too. Let me explain. The descending wedge is a bullish continuation pattern that forms after an uptrend but looks like a downtrend. It's characterized by convergent trend lines where both support and resistance slope downward. Price is consolidating, temporarily. Consolidation is generally looked upon as market indecisiveness. Price is moving between two ranges for an extended period of time. In our case, the consolidation forms a wedge-like pattern where the lower trend line is steeper than the upper trend line as price makes lower highs and lower lows. The upper trend line represents resistance while the lower trend line acts as support. Both trend lines slope downward, indicating a decreasing range of price movement, i.e. consolidation. Trading volume is declining, suggesting a potential decrease in selling pressure. Bears are weakening, buyers are regaining control. The bullish breakout occurs when the price breaks above the upper trend line. This breakout is typically accompanied by an increase in trading volume, confirming the uptrend continuation brought to you by buyers back in control. We enter after the breakout, setting our stop loss slightly below support or our lower trend line. Our take profit target is a key level of support and resistance. It takes less than 2 hours and we exit the trade profitably, risking $100 to make $300 or a risk-reward ratio of 3-to-1. Our fifth and final bullish chart pattern is named after its appearance. The bullish flag pattern is a continuation pattern that signals a brief consolidation in an existing uptrend before the uptrend continues. It's formed during a strong upward price movement known as the flagpole, followed by a rectangular shaped consolidation, which is the flag. The flagpole is a sharp, nearly vertical upward move in price, representing strong buyer power. The flag is a rectangular consolidation that slopes against the prevailing trend. It usually occurs with lower trading volume, indicating a pause in market activity. The lower boundary of the flag is support, which we draw by connecting the lows. The upper boundary, acting as resistance, is drawn in parallel to support by connecting the highs. As always, we enter after the breakout. The bullish breakout occurs when the price breaks above resistance, signaling buyers are back in control. We go long. Our stop loss is placed outside of support, below the lower boundary of the flag. Our take profit target is based on the height of the flagpole, projecting that distance upward from the breakout point. Less than a day later, we made $350 for every $100 we invested, achieving a 3.5-to-1 risk-reward ratio. A word of warning, no pattern works 100% of the time. You must always exercise proper risk management by setting stop losses to limit potential losses. Remember to regularly review your trades to identify patterns of success and why certain setups result in losses. There is no one right chart pattern, but the beauty in bullish chart patterns is your ability to confirm when bulls are moving the market higher, because when that happens, you make more money. If you found this information helpful, all I ask is that you like this video and subscribe to the channel. It takes 2 seconds and 2 clicks, and it means so much to me. Remember to check out my other videos, and thanks for watching.